When you have extra funds, it can be unclear how to best utilize them. Save for real estate, invest in company stocks, cryptocurrency, pay off a mortgage early, or look for other opportunities. I propose a detailed sequence of investment tools to help you determine where to allocate your funds first and where to avoid rushing into. I will also explain why each of these strategies is important. The first and most important step is to pay off high-interest debts. Interest rates on credit cards and other loans can reach 10% or more. No investments will yield returns comparable to the interest you pay on such debts. Paying off high-interest debts is equivalent to investing in a risk-free instrument with high returns. Start by listing all your debts and focus on those with the highest interest rates. This will reduce your overall financial stress and free up more funds for future investments. Once you have paid off unfavorable debts, the next step is to build an emergency fund or safety cushion. This fund should cover your current living expenses for a period of 4 to 7 months. The size of the fund can vary depending on your personal situation, such as the stability of your income sources and the presence of other assets. The emergency fund should be kept in safe and liquid instruments such as savings accounts, short-term bonds, or bank deposits. Additionally, you might consider partially storing reserves in gold or Bitcoin to protect against inflation and market risks. Open a regular brokerage account to invest in the stock market. The historical return of the stock market is about 7 to 8% annually, which is roughly 5% above inflation. Investing in stocks requires careful analysis and diversification. Ensure that your portfolio includes stocks of various companies from different economic sectors and geographical regions. Invest for the long term to benefit from the compounding effect and smooth out market fluctuations. Start with index funds or ETFs, which offer broad diversification at low costs. If you have a mortgage, evaluate whether it is more beneficial to pay it off early or invest in other assets. If the mortgage interest rate is higher than the expected return on investments, it is better to pay off the mortgage. For example, if your mortgage rate is 5% and the average annual return of your investment portfolio is 8%, it makes sense to invest rather than pay off the mortgage early. However, if the mortgage rate is above 8%, early repayment will be more advantageous. Along with stocks, consider investing in bonds to reduce risk. Bonds, especially high-rated government and corporate bonds, provide stable income and lower volatility compared to stocks. The yield on bonds is about 2 to 3% annually above inflation. Including bonds in your portfolio helps diversify risks and ensures a predictable income stream. Keep a portion of your investments in bonds, especially if you are approaching retirement age or want to reduce the overall risk of your portfolio. Cryptocurrencies, such as Bitcoin and Ethereum, have become an important part of a modern investment portfolio. I have been consistently investing in cryptocurrency for several years, buying Bitcoin every month for $100, regardless of its current price. The long-term approach helps smooth out market volatility. Over the past 5 years, the balance of my cryptocurrency portfolio has increased several times. It is important to understand that cryptocurrencies are associated with high risks and volatility, so their share in the portfolio should be limited, for example, to 10–20% of the total investments. Alternative assets include gold, commodities, shares in small companies, investment real estate, and collectibles. These instruments help diversify the portfolio, but come with high transaction costs and risks. Gold and commodities serve as protection against inflation and currency risks. Investments in startups and private companies can bring high returns, but require a deep understanding of the market and readiness for potential losses. Collectibles, such as art and antiques, can appreciate over time, but may have limited liquidity. If you have a subsidized mortgage with a low rate, consider early repayment only if you are not willing to take even minimal risk. In this case, the yield on safe instruments is usually higher than the overpayment on the subsidized mortgage. For example, if the rate on a subsidized mortgage is 3 to 4% and the yield on bonds and other safe instruments is 5 to 7%, then investing these funds might be more profitable than early mortgage repayment. If you want to build your initial capital but feel that you lack financial literacy and knowledge of investment strategies, I suggest you subscribe to my channel and write the word investments in the comments. I will send you a detailed guide on investments and an effective strategy with 3 ways to invest your money so that it generates passive income for you throughout your life, all for free. The money will truly start accumulating in your accounts and you will have more of it. Check it out. Write investments in the comments and start learning.